For more on the jobs data, let's bring in Lauren Saidel-Baker. She's an economist at ITR Economics. Lauren, thanks a lot for joining us. Let's begin with the U.S. What's your take on the much stronger U.S. non-farm payrolls number?
In the U.S., this really continues the story we've seen up till this point this year. A very strong, very resilient jobs market. I'm surprised by the strength of this headline beat. Again, I would want to see the revisions in future months. We've seen some very big swings in past data revisions. February lowered very slightly. Again, that was still a strong number. So it seems that the U.S. market is still very tight, still very much an employee's market.
So the big takeaway is, of course, the big question on investors' minds, what does this mean to the U.S. Fed? Does it wait longer to reduce its interest rate? Will it reduce rates fewer times this year than many market participants have expected?
At this point, I would say at the margin, this large beat would give them a little bit of pause, but we have a lot of data coming before their June meeting. I think this is just one more input. This won't be the key input that, say, makes or breaks that move. So I don't think this takes a June rate cut off the table. I want to see what the futures market is pricing. But at this point, I think mid-year is still very likely, again, dependent on future data.
Lauren, it's John O'Connell. Good morning. What do you think the Federal Reserve Board really is focused on here? I mean, market participants seem to be looking every day for the new piece of guidance and jumping around. If you had to really guess personally what you think is going to happen a year from today with regard to the economy, forgetting about the data points, that I think the average estimate was 202,000 jobs, and nobody ever gets it anywhere close. What do you think is going to be, where the economy is going to be? Is it going to be stronger or weaker?
Well, the general direction is still that things are cooling off. So I think to your first question, the number one thing the Fed is taking away from this release, that is the wage data. And that for, I believe it was 4.1%, is still moving in the right direction. Chair Powell has said many times, we don't need to reach 2% inflation. We just need to be headed in that direction consistently, sustainably enough before the Fed starts cutting rates. They've also signaled, though, that they're in no hurry. They don't want to move too quickly. So they do want further cooling in that wage inflation number. Again, a big headline beat like this will certainly surprise the markets, but seeing that wage inflation continuing to cool, that's the Fed's number one takeaway. That's why I don't think we're too concerned with a June cut coming fully off the table with just this data release.
And you mentioned, Lauren, that you'd be interested in what the futures market is pricing in. My Bloomberg screen is telling me that the U.S. futures currently at this moment pricing in a 69% chance of a cut at the June 12 meeting, a more than 100% chance of a cut at the July 31st meeting. Let's swing to Canada. There, once again, as is very, very common, we get a number completely at odds with what the economist community had been expecting. A modest loss of jobs, 2,200 jobs lost in the Canadian economy versus 25,000 jobs expected to have been added. And one of the numbers that really jumps out is the rate of unemployment in Canada is now meaningfully above 6%. And we should show viewers a view of the Canadian dollar because it is moving on these numbers as well. The currency market making a forecast on perhaps where the Canadian, what the Bank of Canada is doing. There you see the dollar dropping significantly on this news. What's your take, Lauren?
This is the big surprise to me today. I did not expect job losses in Canada. Now, for quite a while, we have seen population growth in Canada exceed the rate of job creation. So that has been moving to cool the labor market, right, to ease some of that tightness in Canada. Increasing the unemployment rate up until this point. But outright losses in jobs, that I'm a little bit surprised to see.
I'm just going to tell viewers the same thing about the futures market. The futures market now pricing in a cut in Canada on June the 5th at 78%. And if not that, then a more than 100% probability of a cut on July the 24th, the following Bank of Canada meeting. Let's talk about these wage growth numbers, both, of course, meaningfully above 2%, which is the target of both central banks on inflation. In the U.S., wage growth coming in at 4.1%. In Canada, wage growth coming in at 5.0%. Are these wage growth numbers continuing to make it more difficult for the banks to tame inflation?
They are. They are certainly the stickier component of inflation right now. So we see overall producer prices starting to ease. Commodity prices, right, have flattened a lot. Even with some of these geopolitical tensions, shipping costs have come down. But wages are really that last sticky component that are keeping costs higher. So the central bank is very closely focused on that, and central banks globally. So we want to see businesses start to adjust. There is no real easing in the labor market, at least here in the U.S. in the near term. We're going to need to see productivity gains to take down these overall costs.